Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to talk to Mr. Matthew Sullivan today. Matthew is the founder and full-time CEO of QuantmRE, a serial entrepreneur. He's the founder of crowdventure.com and co-founder of 2 real estate funds. And actually, it's funny, we were chatting before the podcast and he had an apartment in New Delhi, India. And of course, you guys know from my accent as well that I am from India. So we had fun chatting about how New Delhi has grown and has a lot more traffic right now. So welcome, Matthew.
Alpesh, thank you for having me on.
Absolutely. Hey, Matthew, my first question to every guest is tell us something funny or interesting about yourself.
Funny or interesting. I used to fly helicopters.
Oh.
I used to only because I just haven't flown recently, but I'm an avid aviation enthusiast. Anything to do with aviation or car fuel gets me going. I used to work with Richard Branson for a number of years. I was the one of the trustees and director of the London Air Ambulance. So there's a couple of things there that I also wrote a book which has been acknowledged actually as the cure for insomnia.
That's why I asked you to send me one copy because I do have issues sleeping. But that's amazing. So you were flying helicopters. That itself is interesting. But when you brought up Richard Branson's name, wow. So did you actually interacted with him directly? Wow.
Well, the way it started was that this was a long time ago, back in the sort of late 90s. We had this idea to fly around the world in a hot air balloon because that was the last great global challenge that no one had done. So we happened to own a hot air balloon company owned by a guy called Per Lindstrand. We were the majority shareholders. We had a small corporate finance company. So we wrote to Richard Branson and said, we think this is the last great adventure. Would you like to fly around the world and we'll build the hot air balloon? And he wrote back and said, yeah, why not? So we became quite friendly with him because we were doing this balloon thing. And so because of that, we got involved with a whole bunch of deals, Virgin Cosmetics, Virgin Clothing, Virgin Brides, Virgin Jets, Virgin Helicopters, V2 Music. So we were, in and out of his offices for 3 or 4 years.
That's awesome. Yeah. And then I love to talk about him again, other than the podcast. So yeah, that's great.
No, of course. Yeah. I did bump into him, I think about 10 years or so ago. I think it was at a Clinton Global Initiative conference. And there was that moment where we both sort of went, oh, hello. And you could see that he recognized me, but I think he has absolutely no idea who I was. And rightly so. So those few years were good fun. I wish I could have them again.
Yeah, of course. He deals with so many people, of course. But that's great. So let's talk about the home equity contracts. And you mentioned house rich and cash poor. What does it mean?
Well, if you think about the average homeowner, what you do is you spend many years paying off your mortgage. And as your house increases in value, the result of that is the amount of equity that you have or the amount of ownership that you have in your home, typically increases year on year. So what that means is you may find yourself in a position, if you're one of the millions of people that have lots of equity in their home, where you've got the bulk of your wealth trapped in the equity in your home, but you can't get hold of it unless you go back to the bank and borrow money.
So and that's what we have been taught, right? Oh yeah, when you have equity, go ahead and do a cash out refinance or get a HELOC,
exactly.
Right?
And that works as long as the bank says, sure, you can borrow money. And as long as you've got the income to support that additional debt. So if you find yourself in a position where, for whatever reason, you can't borrow money, so let's say your credit score is too low, or your debt to income ratio is too high, or you might have some sort of self-employed income that the bank doesn't understand, or any number of reasons. You may have just lost your job, for example. You could be sitting hundreds of thousands of dollars of wealth, but you would be unable to access it. Now, the way that our programs work, we don't lend you money. So what we do is we invest in the potential appreciation of your home. So the way that we get paid is by betting on the fact that your house is probably going to go up in value over the next few years. We take a share of that appreciation as the return on our investment. And agreements are structured so that they are absolutely not alone, because they're an investment in the future appreciation. There are no monthly payments. So because we don't charge you interest, because we only get paid when you sell your home or if you decide to buy back the agreement, the amount that we get is entirely dependent on how much your house has gone up in value.
Got it. So let's take an example then. I think I understand, and I'll throw my example itself so that So let's say I have a property and my mortgage is $500,000 right now, and if the property is worth $1 million, and I was thinking of getting refinance, but let's say if I reach out to you, how would that work?
First of all, you would qualify. So the first question is, do you have enough equity?
Okay.
So the rule of thumb for us is that take the amount of mortgage you have, add the amount of investment that we're going to give you, and that has to be less than 75% as a rule of thumb.
Okay.
Sometimes we can go a little bit more than that. So we've got a fair amount of flexibility. So what we'll do is say, let's say you want to unlock 10% of the current value of your home. So that's $100,000.
Okay.
So our agreement would say, when you sell your home, you can be anytime in the next 30 years.
Okay.
Depending on the
agreement. So there
agreement.
is no contract that you have to sell within certain time frame. It could be anywhere.
Yes, you've got up to 30 years.
Got it.
So in that situation, well, that's right. So it gives you time to sort of do what you need to do. When you sell your property, you would pay us back the original $100,000 that we invested to get the share of the increase in value. And the share of the increase would be between 3 to 3.5 times the amount that we invested as a percentage. So if we invested 10%, multiply that by 3. So we would get back 30% of the increase in value. So if your property has gone up from $1 million to say 1.1 million, then we would get $100,000 back plus 30% of that $100,000 increase. So the return on our investment, we would get $130,000 back, but you would have had $100,000 with no monthly payments.
Right, that's huge.
You can use it for whatever you want. So you can actually use it to pay off your existing credit cards, or you can pay your mortgage down with it. So because it's not debt, it doesn't appear on your credit report as an additional loan. So if you're in a position where you're sort of struggling to meet your credit card payments, and many people are, this is a really good way of unlocking the equity in your home to get rid of that problem. But on the other side of the coin, if your house rich and cash poor, you can use some of your equity to invest.
Yes, that's what
and maybe
I was
buy
going.
Another property.
Great minds think alike. I'm always thinking about investment. I'm not, about. That's my opinion, that you shouldn't even have a credit card debt or student debt.
Yes.
You want to start investing, first get rid of the debt. And then, if you get something like this, definitely go ahead and start investing. This is how you can compound money.
Absolutely. Now, the really interesting thing is that your house, the more you pay down your mortgage, the less efficient your home becomes as an investment
Yes.
vehicle. You're reducing the leverage. So the funny thing is, if house prices go up by, say, 4% a year and you have no mortgage, your asset is only going to increase by 4% a year.
Yes.
So it actually makes sense to say, well, if I could unlock some of that and put it into something that gets me 10 or 12%, theoretically, I'm quadrupling the return just by moving money out of my home into another investment that can give me a much better return. And I can get cash flow. So I could unlock money from my equity by some form of investment. It could be a REIT, it could be a down payment on a rental property, and I can start getting cash flow. So I'm converting my home equity into cash, into mailbox money effectively. So it's a really useful tool because you haven't got those monthly payments. So if something changes with your investment, you haven't got that burden of thinking, oh my God, how am I going to find that sort of extra $2,000?
Right. So you mentioned a couple of great points, right? One is, if something changes with your investment, that you don't have the burden because you don't have to sell that investment right away. A lot of time it's the emotional, right? You put money in stocks or crypto, and now, because you have 24/7 liquidity, you end up selling them because you got to get, take care of this payment. And the second point I wanted to harp upon is the net worth. So when we calculate the net worth, remember the primary residence is not counted, right?
Exactly.
So even if you have $1 million, $2 million house, as you know, you and I are from California. You recently moved out of California, but everything here is over $1 million, $2 million, right? It does not work. It doesn't matter, right? When I'm calculating my net worth for my real estate investment, they don't even want to see my primary residence. So if I'm able to take the equity out and reinvest, now that investment would be considered in the net worth.
Absolutely. And we can unlock up to $500,000. So in your situation, you could unlock that in that example, $200,000, possibly 250. So it's not a small amount.
Yes,
so
it's huge.
And we've worked with people that have unlocked the full $500,000 because they have, properties that are worth $4 or $5 million.
Yeah.
Where they're, we've got one or a number of customers who have owned their homes free and clear. They've made money, they paid their mortgages off, and they're sitting on this asset, and they're thinking, well, hang on, this isn't doing anything for me, and I don't want to borrow money because, funnily enough, even though I've got a $5 million property, the bank won't lend me anything because I don't have any income because my
exactly you don't have the net worth, you don't have any income.
So that $500,000, that could be a down payment on a rental property, or there's the list is endless what you can do with it.
So let's talk about my example. Let's say I reach out to you and we went through. So how would it work? Because you said there is no debt, right? Because like if I'm getting cash out refinance, there is a senior loan, which is the the mortgage. And if I'm getting a HELOC, that's a second loan, right?
Yes.
But in your case, then how would the contract be written?
Well, it's an option agreement. Okay. So it's if you were to imagine you've got a friend, you've got a friend, and if you lend your friend money, obviously you're going to charge interest, or if you lend but if you invest in your friend's company, that's an equity investment. So you're not going to expect to get a monthly check. You might get some dividends if he pays, if the business works, but you're going to get your money when he sells his business.
Yeah.
So same idea. So we're investing in your home. We're not expecting to get a monthly payment because it's not a loan. There is an obligation. So we have a relationship now where we've invested in your property. So when you sell it, we want our investment back plus our return. But that's further down the road. So we only get paid when that event happens. And the event is when you sell your home, or if you decide to buy it back at any point. Now, because it's not debt, it doesn't appear as a loan on your credit report. So you can use it to pay off your HELOC, because you're not using debt to pay off debt. You're using your equity to pay off your debt. And we protect our investors' investment by putting a lien on the property. So what the lien is, it's a trust deed. So it's very similar to the type of language that a loan would use, but it's not a loan. So what it does, we refer to it as a performance deed of trust because it describes what the agreement is that we have with you. And so when your property is sold and goes through the escrow process, because we're a holder, we'll get paid out of the sales proceeds.
Yeah.
So
So you get paid directly from escrow, right? So you don't have to
exactly.
wait. Yeah, because you never know. I would take the money and run away.
Well, people tend to be forgetful when it comes to the repayments. It's like I do remember something about.
Yeah, but it was 29 years ago.
Yeah, exactly.
So
that just acts as an aide memoir, as it were.
Got it. So another question I had is, let's say same example, and sorry that I keep going back to the example because I want to pretty much unlock the secrets behind the home equity agreements. Is that, let's say the property I sell after 10 years and it sells for $1 million exact.
Yes.
It maybe because we know the real estate, it's gonna go up and it's going to go down as well. It's not always an up cycle. So what happens in that case?
Funny enough, that's the same question that the investor asks. He goes, "Hang on a minute, this is all well and good in a market that's moving up." So what we do is we build in a bit of a cushion for the investor. Now it depends on the types of agreements and the duration of agreements. But if we're talking about a 30-year agreement, what we'll do is we will apply a bit of a discount to the current value of your property when we start the agreement. So your property would appraise at $1 million, but what we'll do is we'll start the clock running at a slightly lower figure. Now that could be, let's say $900,000. It really depends on a number of underwriting factors. So there's a number of criteria that we look at to determine what that discount is. But we start the clock running at a slightly lower figure. So if your property is sold at the same value, then we've automatically built in a bit of a cushion for the investor, because otherwise the investors wouldn't be motivated to put that investment in. Now, what we do on the other side to balance that is we say there's a maximum return on investment that we can make in the early years. So that means that if you sell your property after like a few months or a year, then we don't get the full benefit of that discount, because that would be a little unfair to you. If we discounted your house, you sold it 2 months later, and you go, "Oh, excellent! We're gonna cash in on that full amount." So we throttle back with a cap. So we say the maximum return we can make in the first 2 years can be capped, and again, that cap depends on the amount of equity you have and a number of other underwriting criteria.
Got it. So there is a lot of other calculations which go behind. And now that I understand that you work with homeowners to provide the home equity agreement, but you have another side where investors invest with you into this home equity agreements.
Exactly, that's right. So now we are a few weeks away from launching our first fund to accredited investors. So when you go onto the QuantmRE platform, let's say hopefully this time next month, you can either unlock equity as a homeowner, or you'll be able to potentially invest in a fund that buys into these home equity agreements. So for the first, as if you're not an institution or a hedge fund or a family office, you will be able to participate in this incredibly interesting asset class, because there's over $15 trillion worth of equity in residential homes. So it'll be the first time that you'll be able to invest in properties that are not for sale.
Right. So what do you think about this asset class? Do you think this could be the next biggest real estate asset class?
Well, it's already enormous. So I think the answer is yes. And the answer is yes for a number of reasons. First of all, the way that these agreements are structured makes it attractive to homeowners. So that multiple that we talked about gives the investors a return that is greater than the house price appreciation. So if they bought a property, they would get house price increases. So they would benefit from the house price increase. But with our agreements, they get the same sort of return, but they don't have to own the property. So imagine from an investor's perspective, how compelling it is to be able to get those sort of equity returns, but without having to worry about toilets, tenants, trash, termites, all those other wonderful
all
things.
The 40s.
Yes. And so this is a great way of tapping into that equity appreciation without the burden of home ownership. Second thing is, there are lots of homes in the US, 15 to 18 trillion dollars worth of equity. So it's a very big asset class. Third thing is, it's a very scalable investment. So, you don't have to worry about picking and choosing, individual commercial deals or looking at triple net leasing. So there are a number of reasons why unlocking the equity like this is actually really exciting. I mean, the challenge for us is just getting investors to understand what the instrument is.
Yes.
And because most people will say, I get this, but what's the monthly yield again? And look, it's an equity investment, so there is no cash pay. And most real estate investors go, hang on, how do I get my returns?
Yeah, and they're used to the cash flow, right? So I'm working on I'm working on a couple of deals. I cannot talk about them on the podcast because they are for sophisticated investors also. So as you know, all the SEC ruling 506B. Yes. But same thing, some of those, the one deal has cash flow, the other one does not. And they're like, oh, when would I get paid? And I'm like, they both are different. That's why, of course, the IRR is higher when there is no cash flow.
But the big question is, how do I get out of this? So
that's always the problem with syndication, right? How do I get out of it?
We are, again, the next part of our plan, which we've been working on for about over 3 years, is to create a secondary market.
Oh yes, that would be the key.
And we think we've cracked it. We're just a few weeks away from launching our secondary market. So you will be able to buy into individual home equity agreements. So you could find, let's say you wanted to buy into, I could be sitting in my house in Boise, Idaho, and I could invest in properties in the Bay Area, and I can pick and choose the properties that I want. I could buy fractions of home equity agreements on each individual property, build my own portfolio, depend where I want to invest, and then through our platform, we will be able to. You'll be able to trade them. So you'll be able to sell your investments in these real estate assets.
No, that's great. Yeah, and we should talk about that as well after the podcast is over. I would love to know more about it, the secondary platform. But I have a couple more questions. One is, let's talk about what are the risks for a homeowner?
Okay, well, the risks are far fewer than there would be with a debt product, because you don't have that monthly, payment hanging over you, where if it's a payment, you run the risk of potential, foreclosure. So the risks are lower. The challenge, though, for a homeowner is you are giving up some of the potential appreciation of your property. Right. Now, keyword there is potential.
Potential. So you don't know. No one can.
So you're, and it's the same for the investor side. So you're giving away something that might happen in the future. And for some people, it's actually quite difficult to grasp because psychologically, we are taught to be attached to our equity and, not to let it go for whatever reason, which I think is very old school thinking. So the risks really are just the fact that you do have this obligation. You would get less back from the sale of your property or from your equity if we have a home equity agreement. But that's all articulated at the beginning. So that's not really a risk. That's just a cost of funding. Now, if we get to the point where the 30 years is up or the 10 years is up, depending on the agreement that you signed, and you've decided that you don't actually want to pay us, then we will need to try and find ways of protecting our investment. And so as a lien holder, we would have the right, depending on the state, to foreclose on the property.
Right.
Obviously, that's the last thing that we want to do, because that makes life incredibly complex.
Because you are also on the, I understand you will be the last in the chain, right? If there is a senior mortgage, then if there is a HELOC, then like I do, then you are the like third in the chain, right? If you try to foreclose, right? And
that makes life,
difficult for everyone.
and again, because we're an equity owner, we don't have anything like the same protections under the lien as a senior lender would have. So really the risks are far fewer than you would have with the debt product.
So then, sorry to interrupt. Then I see there are more risks on your side, and especially even for your investors. So can you specify those risks? Let's say I'm an investor, and what are my risks?
Well, it's a real estate investment, first and foremost. So even though the investment is secured by a lien on real estate, your return is entirely contingent on the future performance of house price values, and in particular that specific property, or if you're buying into a pool of them, those particular properties. So your exposure or your return is entirely dependent on the performance of the house price. There are other risks. So if the homeowner decides to let the house go into neglect, or it becomes deficient on mortgage and the property is foreclosed by the bank or the senior lender, as an equity owner in the property, we have that risk. But we mitigate those risks, first of all, by being very careful which properties we pick. Secondly, by making sure that we don't invest in properties where there is a high loan to value. So you will always have 20% or more equity in your home after our transaction has happened. You still have a large chunk of the equity. So we avoid that problem where you're incentivized just to hand your keys back if things go wrong, because you still own a fifth of the property. So the risks are clear for the investor, relatively straightforward to understand, relatively straightforward to calculate, and in most cases are entirely based on the future potential performance of the house price.
Got it. Hey, so last question before we take a break, that I know there are other companies out there which are doing this, because I get mails at home by Unison, especially, and there are how do you differentiate your, QuantmRE from some of those competitors?
I think really the industry is relatively young. So we've seen a very large increase in the amount of capital that's been invested over the last 3 years in particular. And one of the features of a young market is it doesn't always solve the problem that the homeowners have, because you've got investors on one side of the fence that need to get their returns. And as the market is developing, what's happening is the homeowners, we're finding that many homeowners don't fit in the buy box for a lot of our competitors, because the money that is provided to our competitors has a say in what deals go into their invest pool. So in other words, you get a situation where the tail is wagging the dog, where the investors are saying, we want this particular flavor of home equity agreement. And that means that a lot of homeowners out there don't qualify for a home equity agreement. So we compete because we're going to have a much wider buy box. In other words, we will be able to work with people that have lower credit scores, that have higher debts, yet at the same time, still being able to deliver the sort of returns that our investors want. So our primary ability to compete is by being more flexible and being able to deal with a wider range of homeowners than our competitors, because we're more in control of the money. I think that's our that's going to be something that we hope to maintain. We hope to be far more flexible, continue to be more flexible, which gives us access to a wider range of high quality deals. We're not taking on poor quality deals. We're able to take on more deals that the other companies turn down.
That's awesome. Thank you so much, Matthew. Let's take a quick break. And after the break, we will go through the same 5 questions I ask every guest.
You're listening to the Wealth Matters Podcast. The Wealth Matters Podcast. For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. Matthew Sullivan throws some value bombs today. So Matthew, are you ready for fire round?
I don't know. Am I? Yes, I hope so. Yes.
Yeah, I can see the lights behind you, so we are good.
Yes.
Would you be changing any business or investment strategy after this pandemic is over?
The pandemic, I think, is actually going to be quite good for us. And obviously, it's a terrible thing it has affected millions of people, and it is ongoing. But what it's done is it's just really shaken up a lot of the sort of things in the economy that people thought were there for good. And as far as home ownership are concerned, homeowners are now looking at alternative ways of tapping into their equity,
Yes.
of unlocking their wealth. And I think what the pandemic has done is really just proven to us that things can change on a dime. And so, we're not changing. If anything, we are, we're growing and accelerating our business because there's much more demand now because of the pandemic than I think there would have been had the pandemic not happened.
I agree. So I could see 90% of the metros are on fire. Real estate perspective, they are
Yes.
seller's market, right? As you can see,
Yes.
and I would say even more, 70% of the US real estate has gone up by 20-30% since 2020, since January of 2020. No one would have
Yes.
thought, because people want to move out of New York, San Francisco, the crowded places, to more suburban places, because I'm seeing just in my community it's been crazy.
Yes,
So
absolutely.
yeah, I think it's good for your business, what you're trying to do. So favorite real estate or finance or any other related book?
My partner, so we have a real estate fund, and I've been working with this chap called Tom Bragelman for nearly 7 years. And I think he took about 6.5 of those 7 years to write his book.
Wow.
Which is called The Bank-Free Blueprint. The only reason that, one of the main reason that I'm recommending that is because I know Tom very well, but also the book is written based on decades of experience, and he is a very capable, talented, and successful real estate investor and developer. And so for people that want to get a real inside track without all the bells and whistles and without all the fluff, and it's a great book. And I get paid 75% of the cover price. So no, I'm kidding. So, no, it is.
You wish.
Yes. The book retails at $500. No, it's not. It's a great book, and it's. I can recommend it because I know the people, I know the guys behind it, and I know that what he's saying is absolutely true and very useful.
So I would love to have Tom on the podcast and talk about the book.
I will make sure that, I connect you afterwards.
Awesome. Any tool or website you recommend or you basically use in your business, let's say, to figure out what the value of the property is, other than Zillow?
Yeah, I think House Canary is one of the most useful sources of real estate information, because obviously there's Zillow and there's Zestimates, and but if you look at I think that's good for certain things, but I think if we use House Canary, we've been incredibly impressed about the depth of information, the quality and the accuracy of the information that we get with House Canary. So when we look at things like AVMs and using ways of triangulating valuations with appraisals and BPS, and House Canary is a very effective source of information.
That's great. Any advice for beginner investors?
Yes, I would. It depends, because you've got two types of investors. In simple terms, you have active investors and passive investors. In both cases, I think being an active investor requires a lot more work, but due diligence is key in both cases. So I would summarize, to be a good investor, treat it like a job. In other words, research, don't click and hope, and be wary of emotion. You talked about this earlier, because make sure you have a set of rules by which you make your investments, either by acquiring investments or selling. Because it's very easy for emotion to come into play, and that will enable you to make some of the most appalling investment decisions you probably ever made. So avoid emotion, treat it like a job, in the sense that, build a plan. If this happens, then I will do this. If my stocks go down 7%, then I will sell them. If they, so have your set of rules. So when you wake up in the morning and your, investments, whether it be stocks or real estate, investments or whatever, are not doing what you want them to do, then you can refer to your plan and make sure that you don't make rash decisions based on how much coffee you drank that day.
I didn't know. That's great. How do you give back?
It's a question I get quite a lot, actually. And I don't have a particularly cool answer, other than the fact that I have far too many children. And they're all quite young. So I've got 4 under the age of 9. And
wow.
This is I have a young family, and so if I can not completely ruin their lives as a father, and possibly give them something useful, to take with them through their journey, then I think that's that itself would be miraculous. So I think just if I can just focus on my own family and doing a decent job there, I think the rest will follow.
That's awesome. How can my listeners reach out to you?
Well, the website is QuantmRE.com, and everything is there. So it's QuantmRE.com. So we have we have a free guide ebook that you can download. You can contact us there by phone, by email. There's a number of podcasts and videos and stuff like that. So, and we also have a calculator where you can find out how much equity you could potentially unlock. So lots of things will be happening in the next few weeks. So we hope it will be quite an exciting and interesting place to go.
Thank you so much, Matthew, for your time.
No, Alpesh, it's been a pleasure. Thank you for having me on.
Absolutely.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!